All right. Uh, let's play a game. Okay. I'm gonna name some brands, and all I want you to do is nod if you've ever spent money on this brand or heard of this brand or gone to a showroom of these brands. Okay. Ready? Louis Vuitton, Norton Shannon, Dior, Sephora, Tiffany, and if I'm forgetting, Tag Heuer. Okay. If you have ever spent money on these brands or nodded to any one of the companies which I've just told you right now, you have been spending money on one of the most powerful company in the fashion world currently in this world right now. Yeah, so that's what it is. So it's just one company which has all these famous brands which you have seen in movies, television, everywhere, and you have gone, you have shopped everywhere in this thing. Now, here's a twist which I found out. What if I told you that this brands, all these brands or this company starts giving you something back in return, not as a form of a small coupon discount or something like one-time thing, but more as an owner that you own this company, even part of this company, and you start getting some benefits as an owner here. Now, here's the thing that no one is generally talking about. So, this is also what I found out while learning stock market, while learning about financial investment and all, that there are certain perks which you get out of all these companies, which is one of the things which I would tell you about it and how it works. So, for example, if you have even one share of this company, then you get access to a lot of things which are not open to public. For example, you get access to some of the best private portals. You also get access to the latest trends, latest what do you call things which have still not gone into the market, but still just for the owners are there right now. So you can get the first grabs towards it. And there are tours and stuff like that. There's a lot of things which comes into picture. I'll tell you all about this company. What is this company? How one can benefit out of this company and everything at the end of the video. So be patient with me here. To get to the end, it's also important to understand the foundation behind how one can start their financial journey or in financial journey, or how at least I started. And I'm going to share my experience here. So let me start. And I hope this would be fun. I'm Sarthak Shrivastava. I've been in Munich, Germany since 2016, almost 9 to 10 years now. So I came to Germany, I work in IT, so I came to Germany for a job here. I was working here in Germany. I had a job here. At that period of time, I did not think much about investment, financial markets, and all those things. My only priority was having job, seeing the Europe over there, and then and also learning the German language was itself a fun task to do. Yeah. But later on down the line, after the COVID especially, and I then thought about it that I need to have a parallel source of income as well. And this was one of the major objective which I thought about it. And then I started learning about the financial market. I initially had this perception in my head that, okay, this was more for the MBAs and the investment banking firms, but could be really complex, but it was not the case. In 2022-23, I started to dive more into these topics. I also found interest over here. And what I would like to do is now share my knowledge, what I've learned. So if anyone who is, so when I was here, I did not know about these things. So it took me a lot of time to gather those information. So I wanted to make it more simpler for people who who want to start or are in that phase to start something in this direction. They can learn quickly and then move forward. This is my intention since I'm also learning right now. So my idea is to learn more and share that information. And if you have already gone through a journey and know more or certain things better over there, then please share and comment as well. All right, so let's start. So we'll start with the demystifying of the German equity markets and what is market and everything into that direction. All right, let's go. All right, let's start. So today we'll be going through and understanding what basics of stock market is. Then we will go through what different types of things are there in stock market, like stock, bond, futures, ETFs. Then I'll go further, more detailed into what types of ETFs and what are ETFs and how one can start for a beginner. I'll go more detailed into these things. And then we'll go dive down into the taxes in Germany and especially related to the capital gain taxes and how it affects the ETFs as well. And I'll also show you how we can basically start with any depot. So depot in Germany generally means broker. So you need a broker to have access to the market and then you can basically start. All right. Let's try to understand what exactly is market. Okay. So the first thing which comes to my mind when I think about what exactly is or what actually is market is an image from the movie where there are people shouting and the Wolf of Wall Street type images, and then people saying buy, 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 sell, sell, sell. There are charts going up and down. There are tickers rolling around here and there, and all those things comes to the market. Now to just simplify what exactly is a financial market, we don't have to go much further up. Just drill it down. So basically, it's similar to a normal market as well. So for example, we have RD, or a place. Market is generally a place where you buy and seller meet to exchange a value. Now, this value is basically determined from the consciousness of all people. Now, consciousness is a big word. So it's basically, for example, if you're going to an RD, a supermarket, and then there is a new bread which is in the market right now, and everyone wants that bread. So since everyone wants that bread, and the price of the bread is 5 euros, for example, right now, and since all of them want to, there is not enough bread available for everyone to meet the demand. So what happens? Price of the bread rises. So it keeps on rising from 5 to 6, 7, 8, till the demand is there. Till more people wants it, the more price will keep on rising. And at one period of time, people get bored. No, I don't want to eat that bread anymore. I want something different. So what will happen now? The demand falls. So once the demand falls, the price also falls. So the bread which was now in surplus right now, because no one is wanting it anymore, starts dropping from 10 euros to 8 euros to 4 euros to 5 euros and come down as well. So this is what is called an exchange value. This value is basically set by the human consciousness, and it's same across the globe. So it's almost same for everywhere. If you talk about New York or London or Japan or anywhere in the world, it's almost the same. People are thinking in the same way. Human mind always thinks in the similar pattern. And it's nothing different from the financial market level. Financial market, so in the normal market like ID and stuff, you're dealing with potato, tomato, bread, meats and stuff. In the financial market, we are talking about businesses. So businesses means companies and what they are doing. So basically, you have Apple, Microsoft, Tesla, Siemens, and all those companies are there. And then the value of those companies are determined by the human consciousness and which is same across the world. So the same similar people, Japan will think in the same way, and also same people across the globe in US will also think in the same way. So that's how the financial market, and that is the market basically. It's everywhere. It's running 24/7 and that's why later on when you see, or I don't know if you heard the news as well, that there are gap down, gaps up, meaning the value of the things fall because now people, because of war or whatever it could be, there could be n number of reasons why certain value might fall, or there could be n number of reasons why certain value might go up. So all these things happen based on the sentiments of the people, timing, and that's basically the market. Yep. Now we come to the part as to what can I do. So I understand what market is. Now what do I do with that? So in the market there are certain things, equipments which you can trade, meaning through which I can sell it or buy it, and I can make profit or either loss using that particular equipment. So what are those equipments? So basically you have the first thing which is called stocks. So stocks are basically so you have all the companies like BMW, Audi, Allianz, Siemens, Rolls-Royce, all these companies are there. So what happens with stocks is you as a retail investor or any investor for that matter buy a particular share. So share is a component of that company. So you buy a particular share, so you get an ownership of that company. So for example, if I buy one share of BMW, then I have a ownership of BMW with me for that one particular share. And those are basically the stocks. So you can trade in the market stocks for the company. So if you think that, okay, in future EVs are good and Tesla might perform better, so I buy into Tesla stocks and buy Tesla shares and then keep it for me. And then at the end of the year or 2 years, 5 years, or whatever time frame one has in his mind, then you make a profit out of it. So those are basically stocks. Second thing which is really interesting in the market is called futures. Now this is a more advanced concept, but it's a very interesting concept. So futures is basically kind of looking into the future itself. So currently these happens for indexes, stocks, all the commodities which are there. So every country has a different amount of futures. So it's almost like a contract. So where what happens is, for example, if I'm a wheat farmer or a barley farmer, and I see that in the month of May, my crop right now has price of 100 euros per quintal, for example, and in December the price is currently trading at around 200 euros per quintal. So what I'll do is I will buy a futures contract for my barley for December, and which locks in the price at 200 euros. So what happens is someone at the other hand is agreeing to buy my barley at 200 euro cost in December. So if the price falls in December by 150 or less, then I'm still gonna make a profit, or at least 200. On the other side, the seller is whoever is buying my barley is thinking, okay, the price might go further up, so he wants to lock in the price at 200, because it could also happen that in December it might go more up. So those are your futures contract, which you make a contract in the future months or anything in the future timelines. Why does it affect us in the financial market? Because every indices, so indices are the one which tracks top 50, top 30, top 100 companies of a particular countries. For example, you have DAX, uh, which is the top 50 or top 100 companies. So DAX 100, DAX 50, DAX, you have all those things which basically are the top 100 or top 50 companies of that particular countries. You have Dow Jones 30, which is like 30 uh, top companies of US. Then you have Nifty 50, which is the 50 top companies of India. So all these are indices which are tracking the top companies of the particular countries. So what these futures does is, so you can speculate that okay, in the coming months, German economy might do good, so all these stocks might go up. So I can buy a future for the particular month at a lower cost and then make a profit. So this is more for the traders right now. So I would not suggest it for the beginners. Then you have the forex market. Forex is basically similar to futures. So here also you're making a contract, but it's more dealing with the currency. So you have euro, you have dollar, you have INR, and then if you think that okay, the value of euro might rise, so you buy the euro right now against the dollar, and then once you make a profit, then you can sell it. So it's 24/7, works from Monday to Friday. Every day this market is open, so one can do that. Then you have options. Options is also similar to futures. So futures are also leverage positions. So meaning that if I invest for myself 10 euros, I can buy something of a value of 100 euros. So in that case, I have a leverage position. So it's my 10 euros versus a position of 100 euros, which I would not have. I would have put a lot of money into it. So what happens with this is if I make a profit, I'll make a 10x profit. If I make a loss, also make a 10x loss. Similar things also happen with options. So option is basically like, for example, if you're in Germany or Munich and if you want to rent an apartment and you go and see an apartment and you like the apartment and you like, okay, I want to book this apartment. So you pay a deposit. That deposit is a kind of an obligation at the end of the month, that if you find another apartment which you really like more than this previous apartment, then what you can do is, okay, I don't want the first apartment, I'll go with the second apartment. So you forfeit your deposit. So you're given the deposit back. So it's an obligation. So you don't have to take that first apartment. So options are similar to those deposit money. So for example, I buy an options of Apple at 2 euros per share, and then later on I decide I don't want to buy Apple shares for my own reasons or whatever it is. Then I sell those options, or I forfeit that option, and then I don't have to buy all those shares anymore. So that's an option. Generally, options are used for hedging purpose in trading. But for investment point of view, it's not that relevant. Futures and options are more for the trading community. From investment point of view, one should focus more towards stocks. And there's another thing which comes up, which is called bonds. Bonds are basically government issued treasuries. So basically, governments across the world or the central banks or the big firms would like when they want to make money or want money for their investment. Like for example, government wants infrastructure money. So what they do, they either tax people or they also releases bonds. In that case, you can invest in that bond. So you give the money to the government or those treasury funds, and then what they'll do, they'll give you back interest here. So these are more backed by the government. They are more secure in as compared to stocks, but then the rate of return is also less. And in the bond market, then basically you can buy those bonds. It's as similar to buying a stock. So you buy different bonds from US, from EU, from Germany, or anywhere you want to buy those bonds. and basically then then the government uses this fund, and then they'll provide you some kind of interest. Then the next one is ETFs. These are really, I would say, are like a basket. Basically, ETFs are exchange traded funds. So it's like a basket which contains all different combinations of stocks, uh, also bonds for that matter, also commodities, everything is there. So basically, it's like a big basket where you have Apple, then BMW, Audi, Siemens, Samsung and everything into one basket. So it diversifies your risk, but the growth is also in a similar fashion. ETFs are more, I would say, more beneficial to a beginner who wants to diversify the risk, doesn't know, okay, when should I enter or exit into a stock. So in that case, ETFs are best. And for long-term investment, these are really good because these are managed by the big funds, and then have diversified the stocks, and one can really go into it. So those are the basic amount of ETFs. You have the MSCI World ETFs and other ETFs as well. So let's dive more into the ETF because based on my understanding and my research and how when I started as well, ETFs were the best combination for a beginner. So so what I've done is I have set out what kind of, for a very starting person, what could be the best beginner combination for an ETF. So the first thing is the growth point of view. For growth, generally you invest in equity means stocks. So Vanguard, FTS, All World or MSI World. So Vanguard is a company who manages this ETF. Similarly, you have iShare, which is managed by BlackRock. So these are the big ETFs around the world. So what they do it, for example, this Vanguard FTS All World contains around 3,700 companies across the globe. So you are investing in every big company across the globe, in every country possible. So if you invest in this, basically you're investing in US, you're investing in Europe, you're investing in China, you're investing in India, you're investing in Australia, you're investing everywhere across the globe. So that in that case, since you're investing in the top companies in the world, so it's more secure, and then you have a piece in every small company, so small and big companies across the globe. So in that case, if those company goes up, your value of the product your money will also rise. Then, so generally the combination is set out in a way that you have 55% focus more towards the shares and the stock market. Then you have 40% somewhere in the bond market. So why it's necessary to put something in the bond market is because stock market fell because if there's war, then there was a COVID pandemic or some kind of change in policies, and the stock falls. So in that case, to manage that and to balance your portfolio, it's better. It's also good to have a stability in the bond market. So generally you have the Vanguard Global Aggregate or the iShare Global Aggregate. So it acts as a kind of a safety net, meaning that generally it's seen that whenever the stock market falls, the bond market rises. So one can invest over here, so it balances your portfolio out. So and it's investing in the government. So people generally, so big players like big mutual funds or investment management guys, then they pull the money out of stocks and start placing it into bond for more stability, and this is how it works. Then you also have certain things which like a war hedge. So like 5 to 10% you can also invest in commodities. Like for example, when there is a war-like situation happening, which is currently happening right now, then the price of gold really rises. So if you have seen or if you heard in the news, then last year gold price rose really high. Silver reached all-time high. Similarly, other metals are also rising. So generally it is assumed that you should have some kind of metal investment as well. So this you can do either by purchasing physical metal or by purchasing these ETFs for metals as well. So you have physical gold ETF, you have physical silver ETF, physical copper ETF, and all those ETFs. So what they do is, if you buy that ETF, they have a backing of that similar metal component at their storehouses there, and so generally those ETFs are backed, so there is no problem or there is no issue of bankruptcy or anything because it's managed by big funds over there, so there is no problem. And especially in Germany, till 100K it is secured, so there is no problem here. So this is the ultimate combination which I found out that for a very beginner it really works in a very smooth manner. So you have three max 4 ETFs here, and then 55% is focused on growth part of it, 40% was focused on stability or bond part of it, and 5% you can keep it in the metal sectors so that you balance it out. And this really worked well for me because last year and this year as well, as the metal price goes up, so I, based on my knowledge, increased the metal component, and then overall, my, even though the stock part fell, the metal part went so up that the overall I was still able to make profit there. Yep. Then with ETFs, there's another thing which one has to consider. It's the compounding. So basically, there are two types of ETFs. There is one ETF called distributing ETF. So what does this mean is, basically, if you're investing in an ETF, you're investing in all these different types of companies. Certain companies also provide you dividend, meaning it's a kind of a bonus to the owners that they are faithful to that company and are investing their money in that company. So what they do is monthly, quarterly, half yearly, they provide some money back to the shareholders. Now, since you're invested in those companies, in these ETFs, which also have these companies which provides the dividend, there are certain ETFs which has this DET or DT over there, and then so it's this DUT sometimes as well. So written over there, so this means that's a distributing ETF, meaning that every month or every quarter it will provide you some money back. So it's good for some income generation if you want, but you have to be careful that this money would be taxed. So it's not obviously it's not free, so it will be definitely be taxed. And then there are second type of ETFs, which is called accumulating ETF. What is accumulating ETF? What they do is that whatever dividend you get, dividend you will get either ways, but whatever dividend you get, this ETF will automatically reinvest the dividend back. So in a long-term goal, so ETFs are generally planned for 10 years, 12, 15 years, 20 years, 30 years, and so on. So in the long-term goal, the more you are investing in those, the dividend all gets reinvested, the compounding effect increases, and you don't have to pay a much higher tax. You still have to pay some amount of tax in Germany for also for accumulating ETFs, which I'll explain later. But overall, your money still gets reinvested into it. So at the end, you might make more money as compared to a distributing ETF. Now here, the idea depends upon what do you want. If you want some income also getting generated monthly, then go for a distributing one. If you want more for long-term investment itself, then accumulating is the best there. Then let's go into what does one has to, what's the cost of an ETF. So basically, there are three major important things one has to see in an ETF. So one is called a TER. TER is in kind of an ETF fee. So this is the fee that the fund managers like BlackRock, Vanguard, Almundi basically charges to manage that ETF. So what they do is at the back end, they have a constituent, and then they keep on exchanging the either the countries or the companies as well, so that it's always the top country, top company which is getting invested, and then your money is going in the right direction as per what is present as per the constituent. And what they do is they charge a nominal fee to it, like which generally goes around 0.15% to 0.3%, 5% as well. One has to be really careful. There are certain ETFs which also have lower fees as well. So what they do is at the end of the so whenever you encash it, so whenever you sell your ETFs, then they will take this much percent of your from your profit. So if you had an ETF of 0.02%, meaning that whenever you sell your ETF, then that much amount of fee they will take it up. Second part is your broker fee. So it's broker fee generally in Germany, especially you have the savings plan. So with the savings plan, there is no broker fee, so you don't have to worry about that. Then you have a third amount of fee, which generally people forget, which is called a hidden spread fee. What exactly is this? Is, for example, if you have an ETF which is selling, which you buy at around 100 euros, and the cost of selling that ETF, you just sell it at that period of time, or then it is 99.9 or something like this. Then you have 0.01 cost, which is a difference between buy and the sell price. Why does this matter? Because the higher the price or the higher the difference is, the more money you are losing to that broker. So it's always better to buy the ETFs during the market hours, which is generally around 9 to 5, 9 a.m. to 5 p.m. And There are certain exchanges which are open also before and after, but I would avoid that, because the more you buy in the outside the peak hours, the less it become, the more spread will it will become. So the spread will increase, and then that will cost you more. Generally, whenever you take a savings plan, they will buy during the market peak hours only, so you don't have to worry about it. Then I did some calculation based on a portfolio. If you have 10,000 euros invested into an ETF, then the cost of running that ETF is like 20 euros per year. So that's like one, two coffee, three coffee max. So it's nothing. Now, based on my research for the ETFs, I also got to know certain truth while speaking to people and also doing my own research over there. So this is what I want to do: share how what happens if you manage an ETF on your own versus if it's managed by a bank or fund management, or if you buy this German insurance product. Now, what I've seen is if you manage an ETF on your own, you either have to pay the hidden spread, which is also not so much, or this TER, max to max. Rest of them is with you. Now, what happens with this, if you do the same thing with the bank or this wealth management firms, sometimes you have to see what they are investing at the end. So if they're also, most of them are also investing in the similar ETFs, just that the composition changes. Now, if they are investing in a similar ETF, or ETFs of Europe or US are the mostly in focus, or the world ETF for that matter, which contains everything, then they will charge for you 2.5% or more as well sometimes. So basically you think about it. So they have invested in the same ETF, which if you would have done it, you would be paying 0.02%, and now they're charging, and your money is kept in the similar ETF where they're charging 2.5% just to manage that, which at least for me is too much. Like, I would invest in certain funds if they were investing in certain stocks based on fundamental research, which might go further. Like, for example, like Warren Buffett used to do on certain things like this. But what I've seen and heard in Germany is that people are the capital management firms are very much risk adverse, so they generally invest your capital more in the ETFs itself. So which anyways you can do. So why you want to pay 2.5%? And the third things are the insurance product. Insurance product are more, I would say, uh, has more amount of fees, and there are some hidden administrative fees and other things as well here, which destroys your profit. So for me, one major problem with insurance product is that they enter you into a contract. It's a long-term contract, which and at the end it couldn't cause some problems if you have to leave the country, or if you have to go to US, or if you have to sell it in the middle of the contract. Like, for example, even in smaller contracts here in Germany with like getting an internet and stuff like that, you get stuck sometimes. So imagine if you're putting your money into a bigger insurance product, and not, and they also do invest in the same ETFs and stuff. So there are also some of them you have to see if they're really investing into stocks, which is very and how is the performance of that. If the performance are more, then I would say go with that. Otherwise, what I've seen is most of them also invest in the similar ETFs, and they are charging 3+% as the commission and fees over here. And then at the end, it's the same ETF they're investing, and they're charging more. You get stuck in the contract. You can't sell it in the middle. So the money is also kind of locked in here, and you're getting a similar growth potential. The ETFs will have almost the same growth potentials, irrespective of wherever you are investing through. So because it's the same underlying, so it will have the same growth. So just that you're paying more in insurance product rather than in banking, in the bank funds as well, and rather than doing it yourself. So that's a big fee, and it's not that hard. And then it's the same. You just open it, and then I'll show you later how you can do it as well. It's a simple thing which you can do. So this is what I found out. I could be wrong as well here, but this is based on my research and what I've got to know at talking to more people over here. One of the things which I also learned was whenever someone they in Germany, it's a trend right now to sell Riester and the government funded pension programs as well, which is also good, but has a different objective over there. It's a pension program, so we need pension. They're also investing at the back end, the same ETFs, but then the money gets locked in there. Uh, and yeah, that's something I don't like, because for me, I want the money. It's my money, and money has to keep on flowing, and it should be into my control, whatever I want to do at the end over there. So always ask them as well, where is their money or which product they have taken, because most of them have also not taken the products they are selling. So be careful there. Yeah. Takeaway is, yeah, you get what you don't pay for it. It's at the end same ETFs where most of them are investing. It's just the ignorance of knowledge over here where people generally go, or at least this is my opinion, people generally go with those fund managers and implement product. And at the end, if they're investing the same ETFs, then it really doesn't make any difference. I would only go for such products if they're investing into a lucrative stocks, doing a thorough research. That way I can benefit out of paying such a high management fee. Okay, now this is the ultimate hack for ETF. It's very simple how one can start. So basically, ETFs, best thing, go with the savings plan. Select any 3 or 4 ETFs you want. You can decide when the amount. You can start with 20 euros, 10 euros, 25 euros, 50 euros, 100 euros, whatever you amount you feel you can spare, and continuously keep on putting that amount. So take that amount. It could be as minimum as possible. Important thing is to start. So you can start at first, you can start at 10th, you can start at 20th of any month, you can start. So what happens here is the savings plan gets started. So any broker, all the brokers in Germany, most of them have the saving plan. So you can immediately start. The best part is there is no transition fee. So you don't pay any brokerage fee. You buy every time, so you don't have to worry about if market is going up or going down. You buy every 10th of the month. You simply buy the same amount what you were buying. And at the end of the year, if you see, or now you can also use ChatGPT or Claude or Google it, so you can see the compounding effect from 10 years, 20 years down the line. Your money will definitely grow. And I'm not saying that you can just go research it on your own as well. It will definitely grow because companies are growing, countries are also growing, and it's a cycle which always repeats. So even if you take 100-year uh, charts and everything and analyze it and data analyze it, it's already gone up. Even inflation is going, so everything is going up. Yep. It just takes 10 minutes to set it up. Once you set it up, then yeah, make your the money works for you, and you build your wealth. So it was a saying from Warren Buffett that your money should make wealth while you sleep, and this does it over here. It's really very simple. Now so that's more about the ETFs. Let's dive into the the taxes, because as you're investing, if you start investing in Germany, then you should also be aware of the German taxes and how it affects you. Now, the best thing over here is the capital investment tax is separate from your job tax. So whatever your job income and stuff over here is a separate thing, and then you have a separate point of view where you have the German government generally gives 1,000 euros tax free for any capital gain or any additional source of tax over here, or for a single, and for couple it's 2,000, and if you have a kid then it becomes 3,000. But for kid you have to see you have to invest for that kid itself. You can't just do it for yourself there. And apart and more than that, anything above, if you're a single person, anything about 1,000 would be then taxed at 26.375%, and it's flat rate. It doesn't combine with your other taxable income, so this is separate over here and it will be taxed flat. Now, here's an example. For example, if you're a single person and you make a profit of 1,500 euros, then out of the 1,000 is deducted. So that is yours to keep. And 500, in that 500 will be multiplied at 26.375%. So you have to pay a tax of 131.87 euros, and you take home 1,368.13 euros. If you're a couple, then 1,500 is yours to keep completely because it's still under the 2,000 euro limit, and you take home exactly 1,500 euros. Now, this is the basic tax for the German capital gains here. There's another capital gain tax which you have to be wary of. This is called the pre-tax or Vorabpauschale tax. So basically, what is this? So I think it came in 2022-23. The German government introduced this tax. So basically, what they're doing is this tax will basically be on your unrealized gains. So what does this mean? So it means that if you have an accumulating ETF for a longer period of time and you're not booked any profit on it, so this tax would be basically charged for that. So why they have done it is basically so if ETFs are for a longer period of time, so what they have decided is, okay, if you can hold ETF for a longer period of time and you're not realized the profit, but whenever you do eventually sell the ETF, then this pre-tax which is taken out every month will be deducted, so you don't have to do a pre-double taxation, but they are taking some amount of it out of your unrealized profit. Now, what does it also mean is that, for example, the tax windows goes from Jan till December in a year. So in December, if you are, for example, making a profit of 500 euros, then on 1st Jan, it could happen, as you're not booked the profit, it could happen 1st Jan something happened and the ETF value fell and you're now profit, the profit is now not 500, but it's basically 100 or maybe even a loss over there. So, but in December, it was still profitable. So what they will do is they will book this, they will take this profit, unrealized profit, and take and create a tax on it and take that tax out. So that's what this is. And how does it actually work is, for example, you have a ETF with a value of 10,000. For example, in Jan you invested 9,000 euros into that accumulating ETF. Then at the end of the year in December, you have 10,000. So you made €1,000 profit, for example, there. So now current value is 10,000. So what they will do is they'll multiply this 10,000 into the basic interest rate, which is decided by the central bank. So currently it's 3.2%, multiplied by 0.7, which is a factor they have taken over here. And then you will get an amount. So for example, for 10,000, it will be 224 euros. Now on this, they will apply a Teilfreistellung, which basically means that 30% of your equity ETFs are tax free. So they will only charge up till 70% of your accumulating equity ETF as a taxable amount. So which basically means that whatever base yield you got from the previous calculation, which is 224, will be multiplied by 0.7 again, and then this will give you your taxable amount for this year, okay, which is currently 156.80 euros. Now how the tax will be calculated would be, this is your taxable amount, this will be multiplied by the tax percentage, which is your 26.375, which will basically give you how much tax you have to pay for that ETF in this year, which rounds up to around 41.41 euros. Okay. What is also important is if you're under the bracket of 1,000 euros for singles or 2,000 for couple, then you might have to pay zero tax in this case. This only applies for accumulating ETFs, because in distributing ETFs, since the dividend is paid out, it is already calculated and the tax is already deducted by your broker. You don't have to worry about that. And when eventually you sell this, all this pre-tax will basically be accumulated, and then whenever you sell it out, then they will cut it from the main amount. So only whatever is pending at that period of time, you need to pay tax on that. Important thing, this all will be, if you have a German broker, this all will be taken care of by him. At the end of December, you will start getting some information about this Vorabpauschale tax, so you can go through it and see how it happens. But it's important to know that from a mindset point of view, that even if you have an unrealized gain in ETF in Germany, you will have to still pay tax there, and one has to make that mind that this will happen. So basically, this is what pertains to the tax in terms of ETFs. So let's go further. Don't worry about what is happening in the news, what Trump is doing, anything in that regard. Ignore all those things and just keep on doing it. At the end, even if you do with 25 euros, the time is the main thing over here, because the compounding effect will take place and then you will make wealth over here. So this is what the first thing, do not stop it anyway. And there I come to my second point as well, that do not stop it even when the market is going down. For example, there were a lot of people who, when there was this pandemic from COVID, stopped their ETF because the market was falling. No, never do that, because when market is going up, you're buying at a higher price. So when market is falling, you are actually buying at a lower price, which is averaging it out. This averaging concept works for ETF, but does not work for stocks. So don't do it in the stocks. But for ETFs, since it's a long-term investment and the risk is distributed, so from the SIP point of view, systematic investment process, there you have to keep on investing. Even when the market is falls, where there you're investing and taking at a lower price, because then it will average out, and then since it's a bigger point of view or the view, you will make money. So irrespective of what is happening, keep on investing. Keep it as simple as possible. Here is one of the mistakes which I did at the start. So what I did was, when I just started, I was still learning. So I took ETF of MSCI Core World, IT, and I think another one was AI, I think so, at that period of time. Uh, Problem over there was I thought it was diverse, but the majority of component of those ETF were the same company. So MSCI Core World was also tracking Apple, Microsoft, Meta, and all those companies. IT was also tracking the same company, and AI was also tracking the same company. So in that case, my portfolio was not diverse, but rather it was the same company disguised as diverse, which does not help. Luckily for me, I found it on time and then I changed it. But what I would ask you to do is don't invest so diverse right now. As a beginner, keep it as simple as possible. Go for all, and one for bond and one for metal. And so one ETF for stock, one ETF for bond, one ETF for metal. That should be enough at the starting phase. Later on, when you develop more skills into it, then you can go into sectors. But there you have to be careful that you are not investing in the same companies as part of your original ETF what you had started in all. So and I'll show you later in the in on the site is how you can see what are the components in that ETF, so you can identify as well, and that can provide you basic information. Then another important thing which is really critical for ETFs is rebalancing it. So this is done, I do it once a year. So what I do is, so generally, as I said, you have a ratio of 55% growth, which is on the share market, the stocks, 40% bonds, and then 5% generally is your metals. This is the general balancing which happens. So what happens with rebalancing is, for example, your equity market went up, or how it happened for me. For example, my this year metals rally, so gold, silver really went up. So what I did was I stopped the investment in gold and silver. So for example, my equity fell from 55 to 50, but my metal went from 5 to 10, 15% for that matter. So there are three things one can do. One, first thing, do not try selling the things off. Don't do that. What you have to do is you have to bring it back into the same shape. So what I did was started increasing my investment in stocks and decreasing my investment in the metals. So what happens is at one period of time it came into a balancing here. So it got balanced out. So that's how you do it. This is one way. This is the first way of how to do it. Sometimes when the profits are very high, for example, for me, silver was at all-time high and rallied really way above 15, 20, 30, 40%. It rallied way up. So what I did was, in that case, I did some partial profit booking and also decreased the quantity. So that's how you do a rebalancing of the portfolio. The first approach with decreasing the amount, or making it zero, but still keeping, do not sell it, but still keeping it, and increasing the amount of the other ones can help in rebalancing it as a beginner level. Once you get more advanced, because I also trade in the market, so I know what are the exit criteria for based on the technical analysis. So I was able to do the other part as well. But as a beginner level, keep it as simple as possible. Then there's another thing which I learned was how to optimize your tax well. So this happens, for example, if you are a single person or a couple and you made more profit more than what your allowances are. For example, if you are a single person and you made an allowance uh, profit of 1500 euros for that matter, in that case, 1000 anyways you can keep, 500 you will be still taxed. Now it could happen that in December you might have an ETF where you might have been facing a loss of, for example, 300 euros or maybe 500 euros for that matter. What you can do is you can sell that ETF at loss at 500 and immediately buy it back. Now this 500 loss will get recompensated with those 500 profit, and you might not have to pay any tax for that year because the loss gets compensated here. But you can only do it if you are in profit and only in that year. And sometimes you can also book. So whatever loss are there in my ETFs, I generally book it at the end of the year, buy the same position back. So my position still stays the same, and my loss gets deducted from my taxable income, which reduces my my tax significantly. Here you have to still be careful that this will not reduce your Vorabpauschale or this pre-tax thing. You still might have to pay something, but what I have noticed that it significantly reduces your taxable income, which and sometimes also make it zero in that terms. Then next thing is understanding the pre-tax. So this is really important. You do the fifth part or the tax optimization or rebalancing or whatever you want to do, but you anyways have to pay this speed tax. It cannot be fully avoided. Even if the rebalancing or this tax optimization happened, I still had to pay some amount of pre-tax. It was very small. I think it fell more drastically as well. Once I did my tax optimization selectively and booked my losses, but I still had to pay a minimum. It was not completely zero, to be honest. So this you have to pay, and you have to keep your mind that this will happen. Now, these are my ETF distribution as of current right now. So when I started, as I said, I started with MSCI Core World and also had IT over there, which was not diverse. So those things I did not sell off. I just stopped it so that it is still under the it's still growing, but I'm not putting more money into it. So it's still going into that direction. Now, what I did based on the current market situation. For me, since I'm also tracking Indian market and European market, so I have certain stakes over there, and I wanted to keep it separate because based on the technical analysis, what I do, I can increase a certain stake in my MSCI India or in Europe, depending upon if it's bullish or bearish or how the situation is going. So that's why I wanted to keep all the assets for me separately. But for as a beginner, stick with one. That should be enough. All should work for me. This is currently mine based on my analysis and my technical understanding. So this is what I've said. Emerging market I've kept for me HSBC because it had a lower TER cost, but you can also take from iShare or Vanguard. It's almost same. Important here is also to see what kind of components are there because certain, like for example, BlackRock considers South Korea as developed, but Vanguard does not. So you have to see which kind of allocations you have to maintain. Just make sure that if you have one country in one ETF, do not have the similar one in the other ETF for emerging market because then it will be a clash and that will not diversify it. For bond, I kept it very simple. It's Vanguard Global Aggregate Bond. It was highly recommended everywhere. So yeah, it's basically dealing with US bonds and Euro bonds and also emerging market bonds. So it's safer there. Commodity, I went with gold, silver, and this year more with copper. It's also from iShares, all the three, and this is more of a technical or a tactical hedge what I've taken up, especially with the war condition, and also generally what I've read and also learned is that commodity have a cycle. So generally you have a gold cycle, you have a silver cycle, you have a copper cycle, and it goes on in that direction. So that's why I kept it more as a tactical hedge for me, and I kept the commodities a little bit higher on this side because of the war situation and stuff happening in the world. And I reduced the bonds a little bit. So I balanced it out like this. But this is based on my entry and exit criteria on the chart. So if someone as a beginner wants to start, then go with the basic ones. What was initially suggested, which is 55, 40, and 5. So that would work. This is more on an advanced level. Now this is based on my personal views and my market view. I'm not a financial advisor, so if you are doing your investment, please check on your own, do your research on your own. Past performances generally do not compensate the similar result in future. They can predict a pattern, but it's not a guarantee. So please always do your own research since it's your own hard-earned money. Now I'll do one more thing. I'll also show you how one can also see uh, the ETF. So just go to justetf.com. And here you can type in whatever ETF you want. So for example, you have right now, which one is this one? Yeah, it's the Vanguard FTS All World ETF. So you can see the name of the ETF. This is the ISKIN number. So if you search that in a broker, then you can search this number and you can find it directly. Here you can see the TER. So this is the cost they will charge. Here you can see what type of distribution policy is there. It will be either distributing or an accumulating one. Here you can see the fund size, holdings, and all those things. Important is this is basically under which asset management it is. Then you can see the overall performance of it. So yearly performance of it or whatever it is. You can see here in the charts. Then down you can see here you can see the holdings. This is really important. Now, if you see in this, you have United States, which is at 57.47%. You have Japan, which is at 5%, UK, China, and then there are other countries as well listed over here. So you can see you are investing in all those companies, and the top 10 holdings of this is basically Nvidia, Apple, Microsoft, and you can see the percentage over there. This is really important to see that how much, where is your money getting allocated. So if you take another ETF, then you have to make sure that it's something different from this. Otherwise, you are not diversifying. Now, this is for the Vanguard one. If I search for MSCI, oh, this is cool. Let's search for MSCI on. Yeah. Now, this is for this is same similar one, but this is from iShare or BlackRock. So this is also tracking all the world companies, large track, small track, around 23 developed country, 24 emerging markets. So if you can see, the cost is 2.2% here. You can also see the performance and everything's similar. And here you see it is 57.63. So Vanguard was 57%. Here it is 59%. So this has more US stocks here. And you can also see the sectors here, and you can also see they have lesser, little bit lesser here, and the rest of them you can also see. So the difference is minor, but important thing is if you are investing into it, then you can see if you want to invest into Vanguard or iShare, and then just always check it out here. You can also use ChatGPT, and it will also provide you the information about what type of ETF it is and all those things. Just check it also on the site to confirm it once, and this should be there. As you see, most of those have zero fees on the brokers here. Okay, so those were the ETFs. Now let's go into how you can start. Basically, what's your next path and how one can start with the depot. So these are the brokers in Germany. And yeah, so basically for a broker, you go and find your tax ID. And once you have the tax ID, then you basically go to any of the brokers like Trade Republic, Scalable, Interactive Broker, or any broker for that matter. Interactive is more for advanced ones, so it's more used for traders and stuff. Scalable and Trade Republic are almost the same. I prefer Scalable as I like the English platform over there. They have a good layout. It's also accessible from phone, and I'm just comfortable. And plus, I can find all my stocks and ETFs easily on Scalable, so I prefer that. There's a link below. If someone wants to use that link as a referral, they can do that. Trade Republic is also fine. Both of them are almost similar, so one can use either one of them. Then do a video identification. So if you have a European passport or German passport, then you basically do a video call or identification with your ID, and then you can easily complete that. It just takes 5 minutes max to max. If you have a passport that does not allow this video identification, then you can do post identification, where you take a printout of a form which you have filled out, and then go to a postbank, and then just they will see your passport and do a post identification, and within 1 2 days your account will be ready. And that's it. It's very simple to start an account here, which is also, yeah, it's a good thing. But if you don't have the knowledge, then sometimes it also becomes dangerous because you can really start really quickly, but people just go through it blindly, and that's sometimes very dangerous as well, because you are investing your hard-earned money. So always do your research carefully. Okay, so that now you have started with the repo. Let's go through. So you're ready for your adventure now. Okay. So what we have covered today. So we have covered the markets, we have covered different types of instruments, we have covered the brokers, we have covered the savings plans, we have covered the German tax systems. Now it's time for you to take your next steps and get ready with the savings plan at least. All right. Yep. Now for the surprise element. Yep. So as I told you in the start of the video, there was this company like where Louis Vuitton, Christian Dior, Morton Chandon, Tiffany, Tag Heuer, and all those companies, Sephora. So basically, how you can benefit that. So which company is basically dealing with this? So this company's name is LVMH. So that is your Louis Vuitton, Moet and Hennessy. And this is the main company. So if you buy a share of this company, you get access to all the different doors which are there. So you get access to their wine cellery. So basically they pay out, they give you certain wines, which currently is only deliverable in France. So if you visit France, then you can have that. Second thing is they give access to private portals where you will have a customer portal dedicated for your as a owner, and then you can see the latest products which are getting available and not available in the market. It's first available for you, so you can get the first grab of it, and it is lower than the market price, which is really important here. Then there is another thing, like you get fun magazines and offers over there as well. You can visit their craft shop directly and see how things are working. This is also free of cost. You don't have to do anything there. Then also one more thing, wine cellars as well. If you can go there in France, you can visit the wine cellars. That is also free of cost. They will give you a whole tour, see how things are made and all those things, exclusive collections of Ream and all those other things you can directly do just by having one share. That's it. So these are some of the benefits. Yeah, just having one share, you can have the Hennessy cellar tours, the underground cave tours, and all those things. It really sounds fun. And yeah, the private VIP portal for you. This will be there, and plus, it also provides you a cash dividend, like 13 rupees per share, 13 euros per share. Annually, so which is also given out. So it's also giving you money, and the stock is going up. Then you're also making a profit, and plus you're getting all those perks as a benefit. And you are anyways shopping here, so it's always good. Then these are some of the exclusive offers from the website directly. And as you can see, you have the latest exceptional sites you can visit. You have the private or online space you can see. And there are spirit, wines, tickets, concerts, and stuff which are open and accessible for shareholders, and one can really go and see it. So this is a site, you can visit it on your own, and you can see the amazing educational journey and my expat experience in Germany. I did my own research, also joined a financial institution to learn about how investing and trading works. Yeah, as I said, please do your own research, understand your own risk tolerance before investing even a single euro. Don't take anyone's words for that matter. Do your own research. It's your own hard-earned money, so you need to be sure where you're investing into it. Be careful of the financial advisors which are there as well. Do your own research, speak to a qualified one, ask them as well where they are investing their money. This is one thing which I really learned because sometimes I spoke with few of them and they are actually not doing the same thing. So do that as well. What I wanted to do here was share my own journey and share a map as how one can start, or at least how I started. And this, if it resonates with you, and you learn something from it. I'm really happy if you stayed at the end of till the end of the video as well. Please start your journey if you haven't. If you already started your journey and you're already in the way, if you have learned something which is different from mine, please do share in the comment below. I would be happy to read your comment and also respond to each and every comment here. If something you found was not correct as per your understanding, please comment that as well. I'll try to see how it works out. This video I focused more towards the ETF point of view and going more detailed into it. In the future project, I like to focus more towards how one can also start the investment point of view in stocks, mostly which as I trade as well, so I go into that direction as well. And then you have the concept of fundamental and technical analysis and stuff, and how I do it in that matter. So that would be, if that is interesting for you, please do comment as well. And yeah, if you like the video, please share with as many people as possible. Yeah, looking forward to the next video. Thank you for being here, and see you next time. Bye bye.